Gold and silver markets experienced catastrophic collapse within a single hour. $6 trillion in market value vanished from precious metals markets faster than most investors could react. This wasn't gradual selling or normal market correction. This represented systematic destruction through coordinated liquidation that operated with precision timing and massive capital deployment. Understanding the scale requires context about global precious metals market capitalization. $6 trillion represents approximately 40% of total global precious metals market value. Losing this amount of market capitalization within 60 minutes exceeds anything witnessed during previous financial crises, including 2008 or 2020 pandemic disruptions. The speed eliminates natural market forces as explanation. Normal selling pressure from concerned investors would develop over days or weeks rather than minutes. Institutional liquidation typically occurs through careful execution over extended periods to minimize market impact. One-hour collapses require coordinated systematic intervention. The money didn't disappear into thin air. Market capitalization represents the mathematical product of current prices multiplied by total available supply. When prices decline rapidly, market cap calculations show massive value destruction. However, this value transfers to buyers who purchase at lower prices rather than simply vanishing. Wealth transfer occurs during rapid price movements when sellers accept lower prices while buyers acquire assets below previous market values. The $6 trillion market cap decline represents wealth transfer from sellers who accepted lower prices to buyers who accumulated positions during artificial weakness. Professional traders understand that market capitalization changes don't represent actual money movement. Most precious metals inventory never trades during price movements. Market cap calculations use current prices to value total supply, whether or not owners intend to sell. Price changes create paper wealth fluctuations rather than actual cash transfers. The systematic nature becomes apparent through timing analysis and coordination patterns. Random market selling would show irregular timing and varying intensity. Coordinated intervention shows precise timing with maximum impact designed to trigger cascading liquidation from leveraged positions and panic selling from retail investors. Technical analysis reveals deliberate targeting of key support levels that professional traders knew would trigger stop-loss orders and algorithmic selling programs. Breaking these levels created cascading downward pressure that overwhelmed normal buying interest while forcing additional liquidation from margin calls and risk management protocols. The planning aspect becomes evident through preparation required for such massive coordinated selling. Accumulating positions necessary to generate this selling pressure requires months of advanced positioning. Someone with substantial capital deliberately built short positions while preparing to execute systematic liquidation at optimal timing. Market makers and liquidity providers withdrew during the collapse because normal market-making strategies cannot function when systematic selling overwhelms absorption capacity. This liquidity withdrawal amplified price movements while preventing normal stabilization mechanisms from functioning effectively. The forced liquidation cascade began when initial selling triggered margin calls for leveraged precious metals investors. Margin requirements increased during volatile periods while forcing immediate position closure when portfolio values decline below maintenance levels. This mechanical selling created additional downward pressure. Leverage amplifies both gains and losses while forcing immediate action when positions move adversely. Precious metals investors utilizing 2-to-1 leverage faced complete position loss from 50% adverse price movements. Higher leverage ratios created exponentially greater vulnerability to rapid price declines. Hedge funds and commodity trading advisors maintaining leveraged precious metals positions faced impossible choices between providing additional margin capital or accepting forced liquidation at devastating losses. The compressed timeline prevented orderly exit strategies while forcing simultaneous selling that compounded downward pressure. Prime brokerage relationships complicated liquidation because multiple hedge funds often utilize identical prime brokers for precious metals financing. When systematic margin calls affected numerous clients simultaneously, prime brokers faced concentrated exposure while potentially lacking capital to support all positions during volatile conditions. Retail investor panic selling accelerated the cascade as individual investors watched portfolio values collapse while lacking understanding of manipulation mechanics. Fear-driven selling provided liquidity for professional accumulation programs while transferring wealth from emotional decision-makers to prepared institutional buyers. Stop-loss orders clustered around technical support levels created additional systematic selling when these levels broke. Retail investors typically place protective stops at obvious chart levels without understanding that professional traders deliberately target these areas to maximize forced liquidation. Algorithmic trading systems amplified the decline through momentum-following strategies that generate additional selling when prices break technical parameters. These automated programs operate independently from fundamental analysis while contributing to artificial price acceleration beyond what underlying conditions justify. The US dollar index surge provided the fundamental catalyst that triggered precious metals liquidation. DXY broke through critical resistance levels that algorithmic systems monitor as trigger points for systematic precious metals selling across multiple time frames simultaneously. Dollar strength affects precious metals through multiple transmission mechanisms, including reduced international demand, increased storage costs denominated in local currencies, and systematic selling by currency hedge funds using precious metals as dollar hedging instruments. These effects become pronounced during rapid dollar advances. Currency relationships drive precious metals pricing more directly than most investors understand because metals are priced in dollars while purchased globally using various currencies. When dollar strength accelerates rapidly, it immediately affects relative costs for international buyers while triggering systematic selling programs. Interest rate implications from dollar strength create additional headwinds because higher dollar interest rates reduce attractiveness of non-yielding precious metals compared to yield-bearing alternatives. Professional portfolio managers adjust allocations when yield competition changes substantially. Federal Reserve hawkish signals created market expectations for more aggressive interest rate increases than previously anticipated. These signals suggested Fed willingness to prioritize inflation control over economic growth, even if higher rates damage asset valuations and economic activity. Interest rate fear operates through multiple channels, including reduced appeal of non-yielding precious metals, increased borrowing costs for leveraged positions, and higher discount rates for valuing future cash flows from precious metals mining companies. Market psychology amplified Fed communication impacts because investors interpreted hawkish signals as indication that monetary accommodation era was ending permanently. This psychological shift encouraged movement away from inflation hedge assets toward yield-bearing investments. The timing of Fed communications coincided with technical weakness in precious metals markets, while dollar strength provided additional selling pressure. Professional traders understood this confluence would create optimal conditions for systematic liquidation that could trigger cascading effects. Forward rate expectations embedded in bond markets suggested substantial additional rate increases beyond current Fed policy. These expectations created preemptive selling pressure as investors positioned for conditions where precious metals would face continued headwinds from rising rates. Critical chart analysis reveals warning signals that most market participants ignored while focusing on absolute price levels rather than underlying technical relationships. Professional traders monitor different indicators that provide earlier warning of potential systematic moves. The chart showed divergence patterns between precious metals prices and key technical indicators, including momentum oscillators, volume patterns, and relative strength measurements. These divergences typically precede major price reversals while providing advance warning for prepared traders. Commitment of traders' data revealed unusual positioning patterns where commercial traders increased short positions while speculative traders maintained bullish positioning. This divergence historically precedes periods when commercial traders profit from speculative trader liquidation. Open interest analysis showed concerning patterns where total contract claims exceeded available physical inventory by ratios that suggested potential delivery problems. Professional traders understood these imbalances created vulnerabilities that systematic selling could exploit. Futures curve relationships displayed backwardation patterns that indicated short-term supply tightness, while longer-term contracts traded at discounts. These curve relationships suggested artificial support that could disappear if manipulation targeted specific contract months. The December crash followed by January boom provides historical precedent for current market behavior. Similar systematic liquidation occurred during December, while creating exceptional buying opportunities for prepared investors who understood manipulation cycles. December selling appeared driven by year-end portfolio rebalancing and tax loss harvesting that created temporary downward pressure. However, systematic buyers accumulated positions during weakness while preparing for recovery when artificial pressure subsided. January recovery exceeded most expectations as pent-up demand emerged, while short covering accelerated when prices began advancing. The combination created explosive upward movement that generated substantial profits for investors who maintained positions through December weakness. The pattern suggests that systematic liquidation creates temporary price dislocations that reverse once artificial pressure ends. Understanding these cycles enables positioning for both downward manipulation and subsequent recovery phases that typically exceed initial decline magnitude. Professional money recognizes manipulation patterns while preparing capital for accumulation during artificial weakness. Retail investors typically panic during declines while missing recovery opportunities that systematic manipulation creates for prepared buyers. Current conditions show similar characteristics to December setup, including systematic selling, retail panic, and technical oversold conditions that historically precede strong recoveries. The magnitude of current decline may create even greater recovery potential than December episode. Winners in systematic liquidation include institutional investors with available capital, professional traders who understand manipulation mechanics, and patient long-term investors who maintain positions through artificial volatility. These participants benefit from wealth transfer during panic conditions. Institutional winners typically include sovereign wealth funds, pension systems, and asset management companies that deploy capital systematically during market dislocations. These organizations maintain cash reserves specifically for such opportunities while avoiding emotional decision-making. Professional trading firms profit through multiple strategies, including short covering, volatility trading, and arbitrage between physical and paper markets. Their superior information and analytical capabilities enable optimal timing for both selling and buying cycles. Individual investors who understand manipulation patterns and maintain adequate liquidity can participate in institutional-style accumulation during artificial weakness. However, this requires emotional discipline and sufficient capital to withstand temporary paper losses. Losers include leveraged investors forced into liquidation, retail investors who panic sell during declines, and speculative traders who rely on momentum strategies rather than fundamental analysis. These participants typically provide liquidity for institutional accumulation programs. The emotional component affects retail investors disproportionately because panic selling typically occurs at precisely the worst possible timing. Fear-driven decisions often result in selling near bottoms while missing recovery opportunities that follow systematic manipulation. Leveraged positions create systematic losers because margin requirements force selling regardless of fundamental outlook or long-term investment merit. Professional manipulators deliberately target leveraged investors, knowing that margin calls create predictable liquidation patterns. Silver's volatility exceeded gold's during the crash because silver markets are smaller and less liquid while showing greater sensitivity to systematic buying or selling programs. The same capital deployment creates larger percentage price movements in silver compared to gold markets. The multiplier effect operates because silver's market capitalization represents approximately 1/10 of gold's total value. Identical selling pressure creates 10 times greater percentage impact on silver prices while recovering more dramatically when buying pressure returns. Industrial demand characteristics make silver more sensitive to economic sentiment changes, while monetary demand fluctuations affect silver and gold similarly. This dual demand profile creates greater volatility during periods when both industrial and monetary factors change simultaneously. Silver mining supply constraints create additional volatility because production cannot respond rapidly to price changes. Unlike gold mining, where dedicated operations exist, silver production occurs primarily as byproduct of other metals, mining where silver represents secondary consideration. Technical trading systems often show greater silver position concentration than gold because smaller market size enables larger players to accumulate meaningful positions. This concentration creates greater manipulation potential while amplifying both decline and recovery movements. Options market activity in silver typically shows greater leverage utilization than gold options because lower absolute prices enable larger position sizes with identical capital deployment. This leverage concentration amplifies systematic moves in both directions. Three-scenario analysis provides framework for understanding potential market developments based on key variables including dollar strength, interest rate policy, and confidence levels across different market segments. Scenario 1 involves continued dollar strength and aggressive Fed policy that maintains pressure on precious metals through higher opportunity costs and reduced inflation hedge demand. This scenario suggests continued weakness with potential for additional systematic liquidation events. Scenario 2 incorporates policy reversal where economic weakness forces Fed accommodation while dollar strength reverses through fiscal or monetary policy changes. This scenario typically creates explosive precious metals recovery as conditions that created selling pressure reverse rapidly. Scenario 3 involves stagflation conditions, where inflation accelerates while economic growth stagnates, creating conditions where traditional monetary policy tools prove ineffective. This scenario historically benefits precious metals as inflation hedge demand increases while currency confidence declines. Variable interaction affects scenario probability because dollar strength, interest rates, and confidence levels influence each other through feedback loops that can accelerate trends in either direction. Understanding these relationships helps evaluate which scenario appears most likely. Dollar strength sustainability depends on relative economic performance compared to other major economies, while fiscal and monetary policies affect currency attractiveness for international investors. Extreme dollar strength often creates conditions for policy reversal when economic impacts become severe. Interest rate policy faces constraints from debt service costs, economic growth impacts, and financial system stability considerations. Aggressive rate increases may prove unsustainable if they trigger recession or financial system stress that requires policy reversal. Confidence levels across different market segments provide early warning indicators for scenario changes. Professional investor positioning, retail sentiment measurements, and institutional allocation decisions all provide insight into developing conditions that could trigger scenario shifts. The timing element affects scenario development because market conditions can change rapidly when key thresholds are reached or external events trigger reassessment of fundamental assumptions. Monitoring multiple indicators provides better scenario probability assessment than focusing on single variables. Market structure considerations influence scenario outcomes because systematic manipulation capabilities may continue regardless of fundamental conditions. Understanding professional trading strategies helps evaluate whether scenario development occurs through natural market forces or continued intervention. Risk management during uncertain scenario development requires flexible positioning that can benefit from multiple potential outcomes while avoiding excessive concentration in single scenario bets. Diversification across different precious metals and time horizons provides better risk-adjusted returns than attempting to predict exact scenario timing. Portfolio allocation strategies should account for systematic manipulation potential while maintaining exposure to longer-term fundamental drivers that support precious metals demand. Understanding both technical and fundamental factors enables better positioning for various scenario developments. The educational value from studying systematic liquidation events extends beyond precious metals to encompass understanding of market manipulation across different asset classes. These patterns repeat because human psychology and institutional incentives remain consistent across different markets and time periods. Professional investment approaches incorporate understanding of manipulation cycles while developing strategies that benefit from systematic inefficiencies rather than becoming victims of coordinated intervention programs. Learning these dynamics improves investment results across various market conditions. This analysis examines observable market behavior and systematic patterns, rather than providing specific investment advice or predicting exact outcomes. Understanding manipulation mechanics provides educational context for evaluating market developments while recognizing that professional intervention can create conditions that exceed normal analytical frameworks designed for efficient market assumptions.